Good morning, everyone, and welcome. It's Joe Scarice, your co-founder, co-host of the Creative Bird Strategy podcast and house, held here on Clubhouse every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. We get myself set up here in just a few minutes. I want to welcome everybody to the Creative Bird Strategy podcast, where we break down real estate strategies behind building sustainable real estate portfolios. I'm going to quiet you out there here. Make moderator here. Wait to pull people up. And again, my name is Joseph Scarice, nationwide direct private lender with Park Place Finance, senior account executive. And our goal here is simple: to help investors, real estate professionals, to understand how deals actually get funded, structured, scaled. The podcast is about education, discipline, and long-term strategy because successful investors don't just chase deals, they engineer outcomes. And we're going to dive into a great conversation this morning: qualified inventory versus the real estate investor, what really wins in the market. So let me just invite some people in here this morning and get things started. Dave, good morning. How are you? Long time no see. Dave, are you there?
Out on the trail. So
All right. Good stuff. Good
to
stuff.
see you, brother.
All right. We had two great podcasts yesterday, one-on-ones, which we now do on a second Saturday, traditionally every month. And Dave was our victim this past Saturday. We had two great interviews, and we were in and out of there at 10 o'clock to 12 o'clock. We dived into some great conversation and dialogue. One on credit to capital, and then the other on Burr versus fix and flip, and what was my thoughts behind it. I thought it went really well. I want to thank Mr. Yerdal Perkins of Perkitect, who provided all the technological and social media uh, uh, everything, the video, the work, everything, the setting up of it all with Perkatech. He is just absolutely great, great co-founder, great host of the podcast as well. Let me just get myself set up in here in a second here. So, let's get a little update on the market. Okay, personal thoughts on this week. This week's data, that I reviewed reinforces something where experienced investors already understand. The real estate market continues to move in cycles, driven largely by the bond market, inflation expectations, and global macro events. Over the past few days, mortgage rates have climbed sharply, jumping from roughly 6.09, almost as low as 5.99 earlier in the week of last week, to around 6.41, the highest level since September of 25. The move is largely driven by the bond market volatility and tied to the geopolitical tensions, rising energy prices, both of which push inflation expectations higher. So, from an investor perspective, the environment highlights several realities. First, capital markets, not just local housing supply, is a real driver of the financing conditions. When bonds weaken, mortgage rates rise quickly regardless of the local demand. Second, rate volatility creates both hesitation and opportunity. Some buyers step back temporarily, but disciplined investors who structure deals properly can still move forward while others pause. Third, the fundamentals of real estate investing haven't changed. Cash flow, strong underwriting, and engineered exit strategies still matter more than trying to perfectly time interest rates. Finally, the data also shows something interesting. Purchase activity has remained resilient, with mortgage applications still increasing in recent reports despite rate volatility. My takeaway for investors this week simple is the market rewards discipline. Rates will move, headlines will change, but investors who focus on deal structure, liquidity, and long-term fundamentals will continue to scale while others sit on the sidelines. Another article that caught my eye real quick, and I did post it up this past week on LinkedIn and Facebook: market shifts spurring spike in accidental landlords. And my thoughts behind that: we're seeing more homeowners become landlords, not by strategy, but by circumstances. Higher interest rates, affordability challenges, and longer days on the market are causing many sellers to pivot from selling to renting. Instead of lowering the price, they hold the asset and generate income until the market shifts again. This trend is quietly increasing rental inventory across and many markets and highlighting an important distinction. Owning a property doesn't automatically make someone an investor. Successful real estate investing requires structure, clear underwriting, tenant strategy, reserves, and a defined exit plan. Many accidental landlords will eventually sell. Others will discover the holding rental property can create long-term wealth and become intentional investors. Market cycles always create new players in real estate. The question is simple. Are you reacting to the market or structuring your strategy to thrive in it? So our discussion today, qualified inventory versus qualified real estate investors, what really wins in today's market? One of the biggest misunderstandings in the real estate cycle is the belief that opportunity is created purely by inventory. In reality, markets are rarely constrained by listings alone. They are constrained by qualified investors who understand structure, capital, and execution. Inventory comes and goes with the economic cycles, interest rates, policy shifts. But the investors who consistently win are the ones who are properly capitalized, disciplined in underwriting, and prepared to act when opportunities appear. In today's environment, we're seeing something interesting. There's more inventory slowly returning to the market, but not every buyer is positioned to act. Rising financing costs, tighter underwriting, and operational complexity has created a new filter. Only prepared investors can execute. The investors who succeed in this cycle are those who understand financing structure before they make offers, model conservative exit strategies, refinance, stabilize, or sell, maintain liquidity and reserves, and focus on long-term portfolio performances, not just acquisition. In other words, qualified investors create liquidity in the market, not just inventory. Inventory may create opportunity, but prepared investors convert opportunity into wealth. In real estate, the winners are rarely the ones who find the deal first. They are the ones that structured well enough to close it. So we'll start off with the rose amongst the thorns this morning. Miss Melissa King, good morning. Welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning. Qualified inventory versus qualified real estate investors.
Good morning, Joe. Good morning, Clubhouse. My name is Melissa King, which actually means honeybee, and I run Busy Bee Virtual Solutions. If you don't know, bees are persistent, purposeful, and protective, and that's what we do. We buzz around the back end and help small businesses and real estate investors bring clarity to their documents, digits, and assets by managing their bookkeeping and back office admin. I help investors see the real numbers behind their deals so they know what's actually making money or if they need to pivot and exit out of the deal completely. One of the biggest issues I'm seeing right now is entity cross-contamination, Joe. A typical scenario, LLC 1 owns property A, LLC 2 owns property B, LLC 3 is the management company. Then that investor starts moving money around to keep a bad deal alive. You don't know how that bends my heart. What did you get in the deal for in the beginning, in the first place, if you have to borrow from Peter to pay Paul and then back again? You know what I mean? Clean books protect your liability protection that your LLCs were created for. And that's where a good bookkeeper like us, or if you've got one, go get one, get a referral. They know how real estate comes into play. They really do give you value. I'm having some issues right now trying to convince some of these local real estate investors that they do need to delegate. If you want to move forward, you've got to take something off your plate. Look, I'm doing it myself in my own business. I've hired a couple of assistants to help me move forward. And that is the name of the game if you need to scale up, isn't it, Joe? And with that, I'll give you back the mic.
Yeah, I mean, I never thought about the entity cross-contamination. It's an interesting concept, where a lot of real estate investors do overlook, Melissa, but, if it can have a serious legal, financial, and asset-based, asset protection consequence if it's not managed correctly.
Exactly.
For everybody that doesn't really understand what entity cross-contamination means, and I'll highlight it for Melissa a little more. In real estate investing, entity cross-contamination occurs when separation between legal entities like an LLC, partnership, corporation, trusts, etc., becomes blurred. Okay? And when the separation disappears, a court can potentially pierce the corporate veil, allowing creditors lawsuits or liabilities from one property entity to another. In simple terms, one problem property can infect the entire portfolio. And some common way of cross-contamination happens with mixed banking accounts, using bank accounts to pay expenses for another property or LLC, signing personally instead of the entity. Investors sometimes sign contracts incorrectly. It's like saying my personal name instead of my personal name, manager of an LLC to be that to determined. Shared accounting without proper documentation, one insurance policy covering everything, using the same operating agreements or no agreements, which that scares me the shit out of me actually. Why investors should care? For real estate investors with multiple properties, entity separation is one of the main tools used for risk management. Without proper separation, a tenant lawsuit at property A, a contractor dispute at property B, an environmental claim at property C could potentially impact the entire portfolio. These are some additional thoughts to think about, especially with such qualified inventory out there and versus the investor, and there's such an influx of buying in the entity more so than ever before. So, very good point that Melissa brought because as you're growing and scaling your portfolio, you really need to treat your LLC like a business as you're looking for more qualified inventory versus being an okay real estate investor or a very good real estate investor. Thank you, Melissa, for that additional shift in the discussion this morning. So we'll go. Yeah, any additional final thoughts on that?
Always goes to risk first. So, risk averse.
Yeah, like I referred you that into individual that we were having a conversation. I don't know where that all went with that introduction, but I don't know whether she was getting good or bad advice on selling that property where she would be opening herself up to more liability down the road, where she used some of her um, self-directed IRA money blended with the LLC money and bought a property. Did you ever get the chance to talk to that young lady?
In touch with me, I can do that this week though,
But that was an interesting.
deals with our self-directed IRA, we got to clean up this week anyway. So that kind of puts it in the forefront of my head.
Yeah. So no, she had an interesting circumstance going on, and I referred her to Melissa because I said I don't know whether your attorney's giving you the best tax advice. You need to talk to somebody that before you talk to the CPA. And she's like, "Oh, my CPA doesn't really even have an answer." And I'm like, "Well, you need to know somebody like in the bookkeeping space, before you make more mistakes with this."
Talking to you about that is, has she contacted her self-directed IRA account person for any assistance? Depending on that particular entity, some are good, some are bad, just like anything. And that's one of the first places I would reach out.
Thank you, Melissa. Appreciate that.
Right.
Getting back to, qualified inventory versus qualified real estate investors, what really wins in today's market? We'll go back to Dave Bergio. I think a lot of this was touched in our interviews yesterday, Dave. Wanted to get some follow-up to my dialogue opening in regards to this because I think a lot of it was covered in our discussion yesterday.
Yeah, what's going on, buddy? Dave Bergio here, owner founder of Trifecta Credit Solutions in Allentown, Pennsylvania, to where we get your credit right, personal business side. We help individuals, operators, and investors go from credit to capital, from such things as little as debt consolidation loans all the way to equipment financing and down money. And obviously partnering with Joe. But Joe, man, my ears are ringing. You said the exact sentiments, man. And I don't think it was just yesterday. I think it was, I pretty much saw you almost every day this week. So it was pretty unique. But I think you talked about it at Garrett's meeting as well. And you know why? Because it's getting down to basics. It really is. It's really simple. We touched on it yesterday. It's discipline, like you said. And like when we were talking to that young man yesterday, same thing, coming in, discipline, structure, know your numbers. Talking about cash on cash, $500 per door, 65 to 70% equity. And run this play over and over again. Don't love the deal, like the deal, right? Or don't love the property, like the property. And a great example is that property right next to your office that's been on the market for almost a year. And they had a showing yesterday, and you're kind of rubbing that agent a little bit, which I thought was hilarious. But
I only asked him a straightforward question.
it's not moving. man.
But did you see this? Did you see his face when I gave him that straightforward question? I'm like, hey, t did you notice he scurried away really quick? He didn't want to get into my conversation because I mean, listen, it's a beautiful historical building in Old City, and I found it really interesting that it's been on the market for quite a while, and then I finally got to ask him how much he was asking for, and I'm like, hey, I'm like, I'm like, I don't want to say his name, so I said, hey, what can you make that first floor a residential? Well, it's CMX two, but well, that didn't give me an answer. That wasn't a yes or no. That was I don't know. And I would not want to be stuck with a mixed use building in Old City where there's so much empty storefronts already. You know what I mean? So,
He, uh, he definitely, you could tell he didn't want to talk to you yesterday.
oh, he blew me off like a bad cold. It was really funny. It's okay. Hey, listen, I was very kind and very cordial and very polite, but it was quite hysterical that we were walking by and I hit him up with some of that questions. By the way, guys, and Dave, I don't mean to segue. King, down. Listen, I saw your chat below. I am going to put an article out on that on the cross contamination of the LLCs because I feel like it's very important. So if you're not following me on either LinkedIn or Facebook, please do so because we're going to the podcast that we had yesterday with Dave and I are going out probably sometime this week. We're pretty much up to date on the podcast website as well. We have almost all 150 episodes up there. We've hit over 15,000 downloads. We're now celebrating 2 years with the podcast. It's all on creativeburststrategies.com. And we're going in a very interesting direction with the podcast. Dave's going to get a little more involved with some of the podcasts coming in the future, some of the one-on-ones and things of that nature. I'm going on the road Monday through Friday for the most part. So like I'm not holding um, um, of my own monthly events anymore. I'm strictly sticking to the podcast and the white label courses. I know Dave and I we have a last hurrah monthly event at a Cigar International in Bethlehem, Pennsylvania, April 8th, right? And we have a white label course on underwriting um, in Allentown on April 18th. Anybody wants to come in for that, that's going to be a 9 to 3 course on a Saturday morning. Dave's going to give his insight as well on credit for capital as well. But it'll be a great discussion on underwriting processing, understanding your files, being a better real estate investor, being a better underwriter for your profession for the most part. Any additional thoughts there, Dave?
No, man. I mean, thank you for not only yesterday, but this week, man. It was really good to speak not in the rooms all together. We had dinner together, to talk before the podcast. Always like continuing to learn a lot, and I appreciate that, man. And guys, any of you guys are in the Philly area or want to make the ride up, wherever you're at, highly recommend reach out. Like get yourself out there, have a great conversation with Joe. I had a blast yesterday. It was fun, man. I haven't been down to Old City in a while, and it was a pretty unique, little vibrant time down there yesterday. So thanks for having me. I won't hold you calling me homeless against you. So let's do it again, man.
That was just a joke because sometimes, yeah, there are some interesting people laying around the area where the building is. So I was just joking with Dave a little bit, asking people.
Yeah, coffee, eating that little parfait. So
Yeah, it's all good. It's all good stuff. No, but I appreciate Dave as always. So, Dave brought up something very interesting, and then we're going to get an update from Yardell Perkins in regards to the podcast and the direction of where we're going with a lot of things right now, and some really cool updates that we're working on LinkedIn and AI video and the podcast itself. But characteristics of disciplined real estate investors, they underwrite before they get excited. Disciplined investors never fall in love with the deal before analyzing the numbers. Emotion does not drive the decision, the data does. They think like a lender. Strong investors ask the same questions a credit committee would ask. They understand that structure beats rate. They engineer the exit before buying. Professional investors define their exit strategy before closing. If the exit doesn't work on paper, the deal usually gets passed on. They protect their entities and liability. Disciplined investors respect entity structure and asset protection. They avoid cross-contamination, as we discussed in LLCs, and maintain proper accounting and treat every property like its own business. Risk management is a part of the investment strategy. They build relationships with capital. Strong relationships create opportunity flow. They track performance. Disciplined investors measure everything. They treat real estate like a business, not a hobby. They stay patient. One bad deal can erase the profits for five good ones. Some additional thoughts is that real estate success rarely comes from chasing the most deals. It comes from discipline, structure, patience, and consistent execution over time. The best investors aren't just deal funders, they are risk managers, operators, and long-term portfolio builders. Yordell, good morning. Welcome. Brief overview who you are, what you do, and let's get an update on the Creative Burst Strategies podcast.
Good morning, everyone, for having me. My name is Yardell Perkins. I'm the founder and head of Architect for Shift and Empower Authentic Voices. Our goal is to help organizations build and rebuild their digital presences and platforms through any combination of a website, social media, digital marketing, and multimedia production plan. One of the half jokes I like to tell people is that we did not choose the real estate niche, the real estate niche chose us. Speaking briefly to our future plans, as Joe mentioned, we're getting away from our own events and focusing more on sponsoring and assisting other people with events, people and organizations that are in line with what we do and people we feel comfortable working with and supporting. As far as the podcast, as soon as this talk is over, I'm going to be just going through the last, I think it's literally 3 episodes we will be caught up. So later on this evening, all of you can expect that to be updated today. Moving forward, we'll be going more in the direction of AI, using that to create more targeted content that we can more quickly turn around for just news, information, and on occasionally specifically speaking to our brands and services that we look to have discussions to possibly help people with. And I won't try to speak specifically to Joe on this matter, but I think he's in alignment with me on this, which is why I enjoy and I've found the pleasure and the honor to work with him and call him a business partner and a friend for the past 10 years. When you come to me and we're having it's a conversation as far as whether or not I can help you. It's you tell me what it is you're looking for, where you're at, where you'd like to be, and I try to see if I can bridge that gap for you. If I'm confident I can bridge that gap for you, I'm going to show you a plan. If I'm not confident, the first words you're going to hear out of my mouth are, sir, ma'am, me or Perkatech is not for you. If possible, I will introduce you to someone in my network who might be more of a fit for you. And that's all I have to say on that. As far as today's topic, not much I have to say on that. I'm starting to make more of an effort to get into the real estate game this year. So I'm going to be in these calls more regularly, just listening and starting to do the learning I probably should have been doing a long time ago. But as the saying goes, the best time to start was yesterday. Second best time is today. And apologies for that ramble. Joe, I'm going to take it back to you.
Yordell, thank you as always. Yeah, Yordell has been a great friend and colleague and business association for the past 10 years. And we're really starting to take the podcast to a very specific direction. We will be live. We're always live on Facebook and YouTube. We're probably in about 300 groups on Facebook Live. And YouTube, we're live. We're going to be live on LinkedIn sometime in the next week or so after some other analysis that we're doing. And then we're obviously going to take in some AI video component to it as well. We're working on some other things with Go a High Level, with our CRM and our text messaging campaigns as well. So if you're not on our CRM, please reach out to us privately or email us. My email is on my profile, where you can send your contact information to make sure you're on our CRM to stay abreast of what we're doing, whether it's podcasts or supporting other people's events. Like this week, I'll be speaking at the Connecticut RIA on capital versus non-QM lending. Like, where is the liquidity point of success for the real estate professional. There'll be about 150 investors there. It's Monday night, tomorrow, up in Rocky Hill, Connecticut. So if you're in that market or in that area, love for you to stop by and say hello and introduce yourself. But again, it's one of the largest RIAs in the country and one of the longest running RIAs in the country. So we're getting out there and letting people know, one, about what we're doing in the underwriting space for white label, but also letting people know about our podcast, getting interviews set up with real estate professionals. And this is just a small piece where we're on Clubhouse, and we thank Clubhouse for allowing us to have this opportunity over the last several years. But we're growing. We're the only Clubhouse room that has an official website with 150 plus podcasts. It's just a fact. Nobody else has that. Has all the setups. We're still working on the website itself. We're working on AI video. We're working on all of it. So we're kind of unique group. We're not the biggest group, nor do I want to be. I like more of a qualitative environment than a quantitative. But I want to thank everybody for their engagement through all this as we're growing out the podcast endeavors. Stephen, good morning and welcome. Brief overview, who you are, what you do, and thoughts to qualified inventory versus investor, what really wins in the market.
Yeah, thanks. This is Steve Franco. I'm an investor and a broker up in the Scranton area and run REI homepage. I've been spending a lot of time reorganizing the face of the brokerage to reach out to more agents statewide, because we do focus a lot on wholesaling as well, and not a lot of brokers see that. And, I think that the comment that someone made about, not intermixing your, different businesses and so forth is very critical. It's very difficult to do. I have a line of credit under one business and will sometimes use that to spark investments for the other businesses. And I've been, warned by my attorney that, okay, that's doable if you paper it right. And that's where, honestly, I think I've made mistakes over the years, and, probably everybody has, in terms of if company A loans money to company B, it isn't enough for you to say it. It's enough for you to, put it in writing in some way. And sort of take all that work. But I think that the other thing is that the qualified investor, the qualified inventory, at least the way I interpret that, is when the numbers work. I spent most of Friday looking at a mixed use possible self-storage investment in southern Pennsylvania, and basically the you're there, everything looks great, looks like great possibility, the market is great, all the numbers are in good shape, but this particular property is gonna, the numbers don't work on this property. So the town is a great place to put one, but this particular property, whether we want to rent the land or buy the land, the numbers don't work. So I think that that's always got to be kind of the leading thing. Like you said, don't love the deal. And I did drive home a little bit sad after, kind of doing that, but don't love the deal, like the deal until the numbers come in. And so I think that's kind of my biggest take. And truthfully, it's hard. I run a lot of deals every week, and for my numbers, it's very difficult to make them work. In fact, I had a conversation with my self-storage mentor. I said, listen, we're always kind of just shy of where these deals are closing. What's wrong in our math? And his answer was, it's not what's wrong in your math, is that other people do math differently. For your situation, this is where you should be offering. And if the deal doesn't come through, then you keep moving. So I'm not sure if that was quite on target for what you were looking for, but that's kind of what's in my mind today.
No, you covered. I mean, listen, the don't love the real estate deal, it needs to work. Just because we have an influx of inventory doesn't mean the inventory works for the real estate investor, right? I mean, think about that. Market cycles always create new landlords, Steve, and the disciplined ones turn those properties into long-term assets. You're looking at more of the long-term play in all of this, I feel, in what you were just discussing. You right? You know what I mean?
Yeah, my buying is like 95%, keep it forever. Like in the self storage world, it seems like a lot of people buy for 5 years and sell out, and that build for that gap. I guess maybe, but living for the gap is one thing. But if it doesn't make sense in the interim 5 years, what happens if you can't sell it? So that's always like, and that's why I'm not a great flipper. I'm not good at banking on that spread. I kind of focus on the longer term.
Yeah. I wouldn't overpay for anything right now. I'd be very cautious with this market volatility, but I think it's going to shake through over the next couple of weeks. I mean, literally the market shifts every time the media puts a post out or somebody from the administration makes one announcement or the another. But I want to segue to what you were discussing, Steve, rebranding your real estate profile. The market is, as this market is shifting from inventory to investors, right? So for years, many real estate professionals built their identity around inventory, listings, transactions, and deal flow, but the market is evolving. And as interest rates and financing structures and underwriting standards change, the real opportunity is shifting toward working with real estate investors, not just managing property inventory. Inventory alone does not drive the market anymore. The capital, strategy, and qualified investors do. We're seeing a clear shift across the industry. Agents becoming investor advisors, lenders focusing on long-term investor relationships, brokers building networks of repeat buyers instead of one-time transactions, professionals positioning themselves deal structure and investment strategy. So in the next phase of the market, I think the professionals who understand investors will control the inventory. But obviously, the real leverage today comes from relationships with qualified investors who are ready to act when opportunity appears. I'd love to get your thoughts on that.
I think that that's really important. Is that in the changing market, and really for me in any market, I've kind of never changed my math since we first started investing in '08. Is that the real opportunity is going to be for the people that run the math correctly, and those people who don't run the math, financially correctly. Well, not just what will survive, because this is for me kind of important. What you as a lender will accept as a standard of operation, that makes this deal bankable versus what the investor's actually going to make money on isn't, at least up here, always the same thing. Up here, we have older inventory, more repair costs, more this, more that. So we have to be more conservative with some of our pads. But I think that definitely the math, I think definitely, this is the time to be much more careful, to be much more disciplined. And I don't think a lot of people have figured that out yet on the buyer or seller side. I see things still selling here for 2005 numbers, 2004 numbers, and because people are assuming it's going to get better, it's going to get better. I had somebody say to me yesterday, "Well, this is going to be worth at least 50,000 more in 3 years." I said, "Well, welcome to Northeast PA." No, it's not. It just won't. And on the agent side of things, it's definitely moving. Although I do mostly my own stuff, but it's definitely moving to. It's not just I can get you in the door, therefore I have value. It's I can show you something that will have long-term value, that will actually fit you. The agents and the wholesalers need to do a little more work to make something work to show an investor what works. Because there's so much stuff that is still overpriced. There's so much stuff that is still not on target. It's going to rent for $1,000. Buy it for $100,000. Put another 50 into it. Great. So my rent won't pay my mortgage. So I think what you said is absolutely dead on, basically.
Yeah, in your market and in some of these like rural/suburban markets, you're going to have a big issue with appreciation over the next 5 years. I think we all were vastly spoiled with the big jumps and leaps of values, the standard values, as is values of properties, which I think has skewed the current real estate agent thinking more than what it should be on values on properties and over pumping the idea to their sellers that they can demand these crazy numbers. Last night I actually stopped by a place to grab a cut a cigar, my monthly vice that I have, and I was talking to the owner, and he says, "Hey, you see those houses around the block?" I'm like, "Yeah, they just knocked out that whole commercial section." And he's like, "Yeah, they're going to ask for 1.3 million a piece." I'm like, "Who is going to buy in this specific area in South Philadelphia for 1.3 million a piece with one garage?" And the taxes are going to be at full max value. There's not a lot of markers pulling people back into Philadelphia. Who is that? Who's driving those people into that part of the city? He's like, I have no idea. I have no idea, but they're building them 1.2 million to 1.3 million a piece. I don't get it. And then while they're still building out apartment living just about everywhere in Philadelphia with very little markers of a business coming back into the city. I don't think Philadelphia is any different than any mid-sized city throughout the country. They're going to have problems. You're going to have too much inventory. You have a lot of inventory right now. You have 5 months of inventory. It's almost as bad as 2009. So you're just adding to that. It's just going to be very interesting to watch as a city like Philadelphia what the impact is. But the suburbs are doing very well. It's a very tight market. Surprising enough, Chester County's outpacing sales and appreciation than the other three counties, Delaware County, Montgomery County, and Bucks. So I see a lot of suburban markets slash rural doing well because Chester was always county was always considered rural. Now it's not, it's suburban. So it's very interesting to watch as I see these numbers in my data reports just telling me a lot of different things, a lot of different opportunities out there. And it's shifting away from the urban settings and really leaning toward the suburban settings.
And kind of a quick follow up on that is that that's one of the reasons markets like this or markets like mine are still working is that yeah, we have a couple things that are technically called cities, but we're by no means a metro market. But people are still moving here, people are still investing here because of an affordability logic. You know what?
Yeah.
If I'm not the type that needs the inner city clubs and that inner city life, I can come out here. I can commute to New York. I can commute to Philly if I need to. Whatever. There's opportunities locally too, but I can live here for half the price. In a lot of ways, it's one of the reasons I first came here.
Yeah. If I
You
was
have a good quality of life without as much money. Chester and Philly surrounds is still pricier than here, but it's certainly still pricey to be downtown.
Yeah.
And that's going to help, and people can still get. I mean, you can still get to downtown, and I think that I was looking at real quick when I was down in Southern Town. Is I was looking at one of the places I looked at was a shopping mall to put storage into or whatever, and the thing is, there's a lot going on. There's a lot of negative going on. There's physical appearance going on. There's this going on. There's that going on. And as the guy's trying to sell me not only just putting the storage there, but to buying into the entity, I'm looking around and seeing, in a fairly busy town, third class city, but I'm looking at empty storefront. I said to him, with that empty across the street, what's your play here at the prices you need to get to survive? And he's like, well, I have a refinance. I value the place at $8 million, whatever. He's like, I have a refinance about to be approved for $12 million. And I'm backing off because I know nothing about that sector of retail. But I'm like, wow, 30% higher than I came to. Yeah. This is scary that he's really banking on that kind of value. But people still are, and maybe the shopping center world is different, but people still are banking on values that, when you look at the numbers negatively, conservatively, it doesn't work. And then I see the same thing in residential all the time. And a lot of my wholesaling associates, when they send me their stuff on their buyers list, I'm like, you're asking now for what it's going to be worth finished. It's like, well, that's what the seller wants for it. I said, that's great. How does the investor survive?
Yeah.
Anyway, so that's what I got.
Thank you, Steve. As always, appreciate your time. And we'll definitely have to set up a one-on-one interview in the podcast environment. We have some open slots in April and June. May, I'm going to be teaching the white label course the same time we typically do one-on-one podcasts just because of my schedule. But definitely we'll have to have a chat about that to get you back down into the Philadelphia market very soon.
Sure. Thank you.
My pleasure. So, it's interesting to get a perspective from Steve of his market, because I don't think his market's any different than anybody else's markets throughout the country, where there's that suburban rural opportunity where people can get out of the city. If you're a New York City real estate agent, you should be licensed in Pennsylvania no matter what, because your client's moving to PA most likely for a better overhead, safer environment, less rhetoric. And they're commuting back into the city if they maintain the job position there as well. And that's been going on for the last 20 years, but it's even more so emphasized here than ever before. So if I'm a New York City licensed agent or New York State licensed agent, I would begin licensed in PA as well to complement keeping that connection with inventory and opportunity for real estate buyers, whether it's the consumer or whether it's the real estate investor themselves. I see a lot of, I'm going to be in actually Albany on Monday night, and that market's extremely hot. There's about 150 investors that are going to be at this physical event on Monday. I mean, on Tuesday. So between Monday and Tuesday, I'm probably going to meet probably almost close to 300 engaged real estate investors and professionals between two events. Then I got to be in Massachusetts for another event. I'm going to see a colleague of mine that's in the multifamily space. We only know each other from online. We're going to get finally meeting. He's presenting in Worcester, Massachusetts, and then I'll be driving back into either Lehigh Valley or Jersey for my Thursday event. So I'll be on the road quite a bit, leading off. And then Friday night I have a Philadelphia landlord event, connection event, and Friday night in the city. So it'll be out in the Northeast. It'll be interesting to see what a lot of investors in Philadelphia have to say. Post some crazy council meetings on tenant landlord laws. Felix, good morning and welcome. Brief overview, who you are, what you do, and thoughts to qualified inventory versus in the real estate investor. What really wins in the market?
Buchanan Senior, Buchanan Biz Enterprises, the JLix Group, Grand Rise and Joe, Grand Rise and everybody. Always a pleasure. And thank you for having me. I mean, it really, the theme of what has been this year, probably from the beginning of the year with everything, and especially what happened in Baltimore. Because of what happened in Baltimore, I think that we got a taste of what the market was doing before the market did it, in the sense that in Baltimore City, the where you get most of your investments, the flow of it, it dried up because of the situation that happened. And even previous to that happening, we had been on the podcast speaking about that, things were going to tighten up. The banks were tightening up. A lot of different things were tightening up. We've seen inventory have um, it started being on the market longer, even before the new year broke. So it was already top of mind to say, hey, you got to make sure that your team is right. Your realtors, your lenders, your title companies. Start even before that, get a mentor to properly guide you so that you're actually doing the numbers correctly. A few podcasts ago, we talked about how the market in 2008, where a lot of people weren't in the business back then to understand that the shift that we had to make in 2008 prepares you for anything that happened more in the future. Yes, the um, the details in the situation are going to change from 2008, but that market crash and how that went belly up kind of prepared you for, as you move forward, for a person like myself, that you have to be disciplined within your numbers. You cannot think that just because this property's been sitting on the market forever, at this price, as Stephen mentioned, that if it's at the number where if we rehab it and look to sell it, well, we're already at that price. That particular investment makes no sense. What I'm explaining to people now is call those realtors that's on the MLS and they probably been sitting for 6 months. Some of those sellers will sell it for cheaper. There's a couple deals me telling people that the sellers sold it for 40,000 less than what they were asking for. You don't never know unless you attempt, but you can't attempt to make the numbers fit that don't fit. And then you figure, because as we've been saying ever since I've been on this podcast, you win the deal by when you buy it. You don't buy the deal and then figure, oh, now I can tweak the numbers here and I can do this. Then that ends up being a shitty rehab, period. There's no way around it, because if these were the numbers, there's not enough cutting the numbers as you go through each part. I'm going to cut this in the rehab. I'm going to cut this here. There's not enough cutting that it's going to make the numbers make sense. So if you run your numbers, you do ARV, you do what your rehab is going to be, and the numbers don't work there, then it's not a good investment. And or if you see that it's a good investment, the same thing that I told 3 new investors that I met last week, you got to make sure that you have multiple exit strategies. This ain't like before, where again the numbers were so favorable, and the realtors that were born in these particular years, they got stuck to the numbers being that, oh, well, COVID was an anomaly. COVID, you get 20, 40% returns. those aren't regular markets. So you can't operate as a realtor in thinking that, oh, well, I'm going to get these numbers all the time. And obviously, it shows that the real realtors that absolutely know what they're doing, then they're going to make sure they protect their clients. The other realtors are going to put their investors and their clients in a bad situation because they're going to have them buy out of their range, and now they're screwed. So, um, again, as normal, you got to be disciplined with your numbers. You got to know what your exit strategies are. If you bought it to flip it, well, you got to keep in mind, are you going to do voucher holders? Are you going to do a market tenant? Market tenants don't really work in this particular realm. If you were an investor that you received higher returns on investment or residual income on a monthly basis, which is why when things happened in Baltimore in the city, I pivoted to, hey, you thought about doing Airbnb, you thought about doing traveling nurses, professional rentals where you're going to get more money and those people are going to stay 3, 6 months, maybe even a year. Transitional homes, you can build the infrastructure for that. You can partner with people or companies that they'll handle the day-to-day basis. You provide the property and then you get a higher percentage. So you just got to think about what the exit strategies are and what other things that you can pivot to that you're still able to receive great income. It just may not be the traditional way in which that you would do deals. That's my knowledge and wisdom for the day.
Felix, thank you as always. You gave me a great article to put together from your discussion today. I want to thank you. And by the way, I probably put together 3 or 4 future subjects that are posted into my newsletter and then posted out to various social media sites that my team posts on a weekly basis. And what came to mind in my discussion here, listening to Felix, was appreciation versus cash flow. What should real estate investors prioritize over the next 5 years? And my thoughts, which will be put in an article, it's a very strategic question for investors heading into this new cycle. I don't want to say the next cycle. The answers are purely one of the other, but the priority over for the next 5 years should lean toward cash flow and cash on cash returns. Appreciation is speculation. Cash flow is control. Appreciation is a bonus, not a business plan. Cash flow is what protects the portfolio during market shifts. Cash on cash returns reflect real deal quality. And investors who focus on the metric build durable portfolios instead of speculative ones. The interest rate reality of 2026 to 2030, higher interest rates have changed the investment equation. Properties that produce cash flow today are far more resilient. Forced appreciation still matters. This is where strategies like BRRRR or value add investing still shine. You control the value creation. The most sophisticated investors use a hybrid model. Cash flow protects the downside, forced appreciation creates equity, market appreciation becomes the bonus. The 5 year mindset, investor mindset, is DSCR strength, operational performance, tenant stability, conservative leverage, and refinance flexibility. This approach allows investors to survive volatility while still capturing upside. Bottom line, smart investors don't rely on appreciation alone. They acquire properties that work today, not just properties they hope will work tomorrow. Because in real estate investing, cash flow keeps you in the game. Appreciation makes you wealthy. We're going to come back to Felix, and then we'll go to the other moderators, get some final thoughts in our discussion. What's your thoughts on that, Felix? Just get a quick thought to that.
I mean, I agree. I agree that investors need to change what the outlook is for how they invest in the future. Tweak things a lot because typically it'd be like, oh, you tweak things a little bit. No, tweak things a lot or come up with an entirely new game plan. As I said earlier, immediately when that happened in Baltimore, I immediately started telling my investors, hey, we're not going to get the flips because I had 5 investors and lost a deal 3 days before it was supposed to close because of that happening in Baltimore. And it was the immediate, okay, well, now what do we do? Because obviously, looking to flip properties at the level that we had been or were looking to do, it's not going to work. So, how do I put them in a position right now to still receive large amounts of income that or return on investment that they don't be like right now at all. So now then I lose that money or those investors completely. So you just gotta be very smart, disciplined, and strategic with being a real estate professional, period, that you're making sure that you break down and show your investor what they can do and how they can still make money in these markets.
Folks, thank you as always. Melissa, some final thoughts to our discussion of qualified inventory versus investor. What really wins in the market?
Drop this one. If your books aren't clean, you don't actually know if your deal made money.
It's really funny you say that because, there's so many people I talk to, they're like, I don't think I'm making money on my properties. I said, it has to be your bookkeeping because on paper, you're making money. Because I have this discussion all the time, with clients. Like, why is their numbers not working and my numbers are working for them?
Well, and one of the things I want to is even though I'm providing these monthly deliverables or quarterly deliverables, they don't look at them. Or if we do, they don't make notes, So just pay attention to your numbers. It helps a lot, both in business and in life.
Well, Melissa, thank you for your final thoughts.
Thank you.
My pleasure. And Dave, some final thoughts to qualified inventory versus investor. What really wins in the market?
Yeah, thanks everybody. I mean, Melissa actually hit it head on, man. I mean, numbers. Numbers are everything, and I think the key word, not only numbers in real estate and in business. Like she added there. So many business owners, they don't know their numbers. What's coming in, what's coming out every day, right? It's hey, we're making money, but we're broke, right? So it's know your numbers. And I think the biggest key word out of this, and Joe, and for everybody else that doesn't know, like I'm a huge fitness guy, and even numbers with that, right? Inputs equal outputs, but discipline. Discipline to do those mundane things over and over again. Discipline to like the deal, not love the deal, right? Discipline to run your play. Discipline to stay in your lane. And you just stay on that mundane path. You're going to set yourself up for success. Thank you, everybody. Joe, back to you.
Thank you. Thank you very much, guys. I really appreciate that. And some final thoughts to qualified inventory versus qualified real estate investors. What really wins in the market? And at the end of the day, real estate markets are not driven purely by the number of properties available. They are driven by who is capable of executing when opportunity appears. Inventory will always move in cycles. Some years we experience shortages. Other years we see more supply entering the market due to economic shifts, policy changes, or rising interest rates. But regardless of how much inventory exists, deals only happen when qualified investors with capital, discipline, and strategy are prepared to act. This is where the real difference lies. A property on the market is simply inventory. It's not simply inventory. It becomes a transaction only when qualified investors with financing reserves and clear exit strategies step forward. In many ways, the real estate market is less about availability of property and more about the availability of capable buyers who understand how to structure deals in changing conditions. The investors who consistently win in the market cycle are the ones who focus on fundamentals. They understand financing before they make offers. They underwrite conservatively. They maintain liquidity and build strong relationships with lenders, brokers, and property managers. Most importantly, they approach real estate as a long-term business rather than a short-term transaction. We are seeing this dynamic play out more clearly in today's market. As financing becomes more structured and operational costs rise, the gap between casual buyers and disciplined investors continue to widen. The professionals and investors who adapt to the environment will find opportunities even when others step back. In the end, inventory may create the opportunity, but qualified real estate investors create the market. Because in every real estate cycle, the properties may change, the interest rates may change, and the headlines may change. But the investors who are prepared, structured, and disciplined will always be the ones who will win. I want to thank our moderators today. Excellent discussion, a very deep discussion in the space. We're here every Sunday morning through March. Starting in April, we're going to be doing every other Sunday at 9 a.m. and we're going to be focusing on the one-on-ones on second Saturdays and getting more of those in with real estate professionals throughout the country and regionally and locally. And then we're going to be focusing on the underwriting class on a monthly or quarterly basis for aspiring real estate professionals, mortgage broker, capital partners, and real estate agents. It's just there's only so much time in the day to focus, but we will have a calendar always on the website at creativebirdstrategies.com. We're also going toward the AI video piece. Our our podcast will be live, hopefully this week on LinkedIn, Facebook, and YouTube simultaneously, and then loaded to Buzzsprout, loaded into Spotify, Audible, Amazon, all those great spots that are referenced on the website. But we're definitely the podcast is growing, and we're hitting some milestones which we want to shift in a good way, not a bad way. We just want to make sure it makes sense for all parties, including myself and Yardell, because there's only so much time in the day to accomplish what we're doing. I'm on the road 4 or 5 days a week, so there's only so much energy I have left by the end of the week to provide insight with crisp and defined. But Yardell, do you have any final thoughts to our discussion this morning? Yardell?
No, not this one, but yeah, I am happy to be here. And again, as I said, I'm going to be here on a more regular basis. But thank you.
My pleasure. So again, please reach out to me with any questions in regards to finance as well as Dave Bergio, Melissa, bookkeeping. You want to get into that DMV Baltimore market, you got to talk to Mr. Felix Buchanan, Stephen Franco up in the Hazleton, Northeast Pennsylvania market, go-to guy up in that market. Um, if you want to discuss non-QM lending, whether you want to be a mortgage broker, capital partner, or referral partner, or direct to investor to have those type of discussions, how I can assist you in growing and scaling out your portfolio or your clients, please let me know. We'll set up an appointment right away for that discussion. Please follow me on LinkedIn, Facebook, Instagram. We're posting these articles of discussion. I probably pulled three good articles out from this discussion today. My quote this morning: you are not alone. Talk to your friends. Check in on the people around you. Have the conversations that matter. Connection reinforces something powerful in life. Love, respect, loyalty, and trust in the business and in life. The strongest networks are built on real relationships, not transactions. Everybody have a blessed Sunday morning. Take care of yourself. Have a great week. We'll see you next week on the Creative Birth Strategies podcast and house here on Clubhouse. And I'll be ending the room in the next 30 seconds. And thank you.